Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We have back on the show Jay Martin. Jay organizes the VRIC, the Vancouver Resource Investment Conference, every year. He also has a YouTube channel called The Jay Martin Show. There's a link down below if you want to check it out. He's a commodities bull, just like us. And like us, he is trying to identify the next sector that is going to have a landslide of money piling into it and placing himself in front of it. Jay, thank you for coming back on the show.
It's a pleasure to be here, Steve. Thanks for having me.
Yes. I like your show a lot. You got some top-notch guests on the Jay Martin Show. I think you kind of have the same approach that we do in that you just try to interview some of the smartest minds in the business and then essentially do what they're doing. Is that accurate?
Yeah, it's not far from the truth, man. I started my channel very self-servingly. I'm an investor looking for the smartest home for my cash. I determined that if I could stress test all of my theses and speculations with investors who have been in the game a lot longer than I have, then I would get closer to the truth, And so that's still how I operate today. I might have conviction and some idea. I'll have an expert on who's been in the game, made more mistakes and good decisions than I've ever, and they can give me their feedback on it. Yeah, Jay, you're right on the money, but I think you're 10 years too early, or no, you're way off and here's why, or absolutely, I'm putting cash there too. Doesn't make it right, doesn't make me right or the idea right, but it's nice to crowdsource information like that. I'm a people-driven investor. I invest in entrepreneurs. I have conversations for a living. And so it's natural that I would do this as a key part of my diligence.
Yeah, it gives you a lot more conviction in your bet when a guy who's been in the sector for 50 years reinforces what you see. Okay, we're going to start out big picture, natural progression of empires, shifting balances of power, what happens to the currency during these times. Then we're going to go into where the world economy sits today, talk about interest rates, listener questions, and finish with something that our viewers can do and take steps on today. Find out where you're putting capital and where you see it. Okay, rise and fall of empires. Ray Dalio has talked about in his book, The Changing World Order. And I've noticed that you've had this topic come up with your interviews and your guests recently. And what have you learned about the rise and fall of empires in your own study and from your guests?
That they tend to follow a blueprint, and that when an empire is collapsing, nobody inside the empire believes it could happen. The sun never set on the British Empire. It also never set on the Dutch Empire, never set on the Spanish Empire until, this is a phrase that's been repeated. And the citizens of the empire are usually the last to know that things are going south. They're the last to lose confidence in their currency, and they're the last to lose trust and faith in their government. But the chapters that occur through an empire's life cycle are repeated, time and time again. And you can find repetition of that, honestly, for like 2,000 years. You can go back, to the Roman Empire. You can go back through 5, 6 Chinese dynasties, and even think in terms of recent history, like the last 500 years, you'll see the same pattern repeated with the Portuguese, the Spanish, the Dutch, the British, and I believe the American Empire will also come to an end, right? As these things do. And there's some telltale signs that you tend to see. Generally speaking, currency debasement is the most obvious. People get sort of over their skis. Governments get over their skis in terms of promises being made to citizens. They start relying more on military power and confidence in their military and economic strength, as opposed to their actual trade competency and the strength of their currency. Generally, there's a surge in internal conflicts within the country and a lot of polarization, rise in populism, both far left and far right, arguments to redistribute the wealth gap increases, this kind of self-fulfills. What you generally need in tandem with an insolvent nation with rising internal conflict is an external competitor that can actually apply some serious pressure. And more frequently in history, you don't see one power rise. You see a collection of less powerful nations rise together and coordinate in some way, shape, or form. We're seeing all those things right now. Now that, it can take a long time for an empire to shift in terms of power. it took about 30 years for the pound to trade places with the USD, or I should say for the US dollar to trade places with the pound. But we're absolutely in that. Like if you were to ask me, are we in the rise or the fall of the American empire? I'd say we're definitely in the fall. That's my personal opinion. To what extent? I would say that my family holds American and Canadian passports. I'm not jumping ship. I'm not worried there's a civil war that's going to occur in the next couple of years. Unfortunately, that's how these things usually end. The internal conflict gets to a place where it's irreconcilable and people take up arms. Let's be honest, America is one of the most armed civilian populations on the planet. It could go south really quickly there. My family is based in Canada. We spend a lot of time south of the border. We are currently also putting roots down in Southeast Asia just to have optionality. I'm thinking about my grandkids, right? I'm like, where could I set up a foundation today that would set my grandkids up for success? The same way, I grew up in the 90s in Canada, surrounded by opportunity, safe, predictable governance. Great. I benefited from that. And if I were to search the globe for where 30 to 50 years down the road I could find that, I'm not so confident I'll find it where I found it. And so we're looking elsewhere for it.
That's a very, very good defensive play. I'm working on one down in South America myself. So what I heard you say is that these rise and fall of empires are there is a blueprint. This is not something new. This has been going on for 2,000 years. Some common themes are nobody sees it coming, especially the citizens, and some signs that you're in one is currency debasement, increasing dependence upon the military as opposed to just having good policies and good trades, right? And internal conflict, and other countries rising collectively together to take out the big one. And all of those signs we're seeing right now playing out in real time in America.
Yeah. I mean, generally there is a cycle that's been followed, and that's surge in investment in education leads to a rise in innovation and competitiveness. This leads to economic strength that builds wealth. Wealth leads to access to credit. Access to credit leads to an abuse of credit and an accumulation of debts. Debt leads to fragility, vulnerability, and eventually decline. And you could place that blueprint over a nation. You could place it over a person. I mean, it's the same thing, a family. Like, we go through these cycles, macro and micro. And so, we're seeing it play out right now on the geopolitical chessboard. There was an excellent quote by probably a mutual friend of ours, Luke Groman, in this most recent newsletter, who said the most undervalued asset on Wall Street is a history book. And he's absolutely right. Like we can sit here in denial and say it's different this time until we're blue in the face, but it's rarely ever been that different this time. You know what I mean?
Yeah. Okay. All right. Now we're going to take the next leg of the spider web in. What's your macro view of the world economy and financial markets today?
Well, I think that if I've grown up my entire life in the era of globalization, increased sharing, buying and selling of goods, whatever a country needed, if they had the money or the credit to buy it, they could. It was a global marketplace. I do think that era is coming to an end, has come to an end. I don't think what happens next is going to be simple, fast, or predictable. But absolutely, we're in a tectonic shift and transition period. The evidence that I use to support that thesis is sort of numerous, but one metric I do watch is Greenfield foreign direct investment. So this is, companies that are investing in new factories in foreign countries for whatever incentive they may receive, right? So, Indonesia has been attracting a lot of foreign investment right now, providing tax breaks to companies that want to build in Indonesia. And the trends and look at Greenfield FDI, just for context, as opposed to Brownfield FDI, because Greenfield FDI is brand new factories being built.
Brownfield is, there used to be a mine there and then it went dormant and they're coming back and doing it again.
Correct. They're sort of revitalizing old infrastructure. Greenfield is completely new projects. And so to spot the early trend, I look at Greenfield. And, post Russian invasion of the Ukraine, there's been some massive shifts in the trends of Greenfield FDI. Countries that voted not to condemn or to abstain in the UN vote to abstain or not condemn Russia's invasion have seen about a 38% decrease in Greenfield FDI reaching their economies. China, which used to suck up about 12% of total Greenfield FDI, is down to 2% since then. And a lot of this is being redirected to Mexico, for example, which has recently become the United States' largest trading partner. Now, these things don't unwind overnight, right? These are really, really early indicators of where economies may be strong 10, 20 years down the road. I mean, it took China 20 to 40 years to build the infrastructure to become the world's biggest factory. And those don't shift overnight. But so, anyway, let me just like simplify this a little bit, Steve. If we are entering an era of deglobalization, if countries are not investing with the nations that they used to because of the lack of trust or stability or predictive nature of their governance, all this means is that the future is a bit uncertain. And where we're going to get the things we need is uncertain. We're still going to need those things. We're still going to need oil, still going to need gas, still going to need copper, nickel, energy metals, all this stuff. But we're not going to share it like we used to. And we're seeing these signs all over the place, with China banning the export of all kinds of rare and critical earth metals. Russia just last week issued a temporary limit ban on natural gas and diesel. Indonesia has already put a nickel ban in place. They're bringing in the copper ban next. Malaysia has banned the export of rare earth minerals. Countries are suddenly very aware that the value of raw materials has gone way up because their country's ability to procure these is going to be really, really difficult. And so my projection is that in response to this, there will be a rush to secure the raw materials that every country needs for their supply chains. And we're going to see new alliances formed in unlikely places. We saw interesting negotiation between Iran and the US just last week for the release of some hostages. We're seeing renewed investment in Venezuela, right? And old friends are becoming enemies and old enemies are becoming friends. And there's a rejuggling of the geopolitical chessboard. But on the back of that, it's all geared towards securing the stuff we need. And so, I've never seen a rush for commodities as amplified as I believe we're about to see right now.
Okay. So globalization, you think, is coming to an end. And that's interesting. I've never heard that before, keeping track of greenfield projects like that. And so after the Russian invasion, you said the companies or the countries that abstained from basically putting in their opinion on what they thought on it, they saw less greenfield projects coming into their country?
Correct. Correct. 38 countries that voted to not condemn or abstain from the vote have seen a massive drop off in greenfield foreign direct investment since that date.
And so you said a lot of them are going into Indonesia. Are there any other countries that are kind of soaking up projects?
Yeah, Mexico seems to be the big winner right now. They're definitely leading the pack and setting the trend, which, it makes sense from a geographic standpoint. A lot of that money comes from the US, right? Africa has been a massive recipient, and there's obviously many countries that are jockeying for that capital right now. And, countries are essentially, when I look at that vote, by the way, Steve, the UN gathered, countries voted whether or not to condemn. I think 141 condemned, the balance abstained or did not. What they were really doing, from my perspective, was pledging their allegiance to either China or the US. Yeah. And that's what that vote really said, right? It's like,
So, I'm so glad you said that. Yes.
Yeah.
That's exactly what happened.
Yeah, 100%. And so some countries are saying we're going to stick with, the greatest economy in the world right now, the current empire and the world reserve currency. And there's a handful of others that said, that's never been a good deal for us. We don't believe it's going to be a good deal in the future. And we're taking this option on the rising power. So, that's how I really read that.
Yeah. Okay. So with that in context, what is your favorite bet right now? I'm assuming it's a commodity after what you just said.
Yeah, I mean, I'm a commodity investor, right? So I do eat my own cooking. I definitely invest in a lot of early stage technology as well. But right now, I don't think there's ever been a more opportune time to have an edge in the commodity industry, because we're seeing a rotation in capital away from speculative growth towards value and yield. We're seeing a rush from countries all over the world to secure the supply chain of the stuff we need. We're seeing countries that supply those materials getting very guarded about who they're going to supply it to. All this is a huge vote of confidence that the value of commodities is going to be more respected ever than it's been in my lifetime. So let's allocate some capital that direction. I should state that I'm a long-term value investor. And so when I put cash in a certain area, it's not because I think that's going to pop this quarter or next quarter. My time horizon is a lot longer than that. And I'm typically, in a position for 3 to 5 years. And for example, right now I'm allocating significant amount of capital to mid-tier gold producers, run by managers that I have a lot of confidence in, who have a couple wins in their back pocket, because success tends to beget success. They've surrounded themselves with great people, healthy balance sheets. And I'm walking in with no competition, because I can see a well-managed company run by a serially successful entrepreneur, producing a commodity that central banks are buying up in record rates, but nobody cares. It's a very hated sector right now, and so it's great for me, walking on the open market and buy these things at a severe discount. I state, in my newsletter where I talk about where I might be putting cash, that, yeah, I'm building a position here, but don't expect, that's not because I'm expecting this to pop, in the next 6 months, next 3 months. It might, absolutely. But when it does, I'll be selling or at least taking some cash off the table, and back to how we started, you interview these veterans who have been in the business for long enough, you realize that when a market takes off, they built their positions 18 months ago, and you're buying their shares, generally speaking. It's a long, patient game. And I don't try to time markets. I can't time markets, but I can identify things that are cheap, right? And that's all you got to do if you have the time horizon and wherewithal, and et cetera, et cetera. But anyway, I like the gold sector right now because everybody hates it. I like gold producers because they're cheap. I don't have to go super speculative right now. I can buy companies that are producing 250,000 to 500,000 ounces per year with a path to 1 million. Silver producers similarly, but I'm a bit less exposed there, not for any reason. I just have a lot of strong relationships in the gold sector. I've got quite a lot of exposure to copper as well. Again, I don't think copper is going to pop in the next sort of 6 months to a year. I think there's too much global instability to really support the economic boom that generally rises copper prices. However, it's absolutely, we're undersupplied. That industry has been undercapitalized. We're going to need a lot of it. We don't have any of it. And if any of these, renewable trends continue to move forward, the demand for, copper, nickel, cobalt, lithium, manganese, vanadium, go on and on and on, will be colossal. In the energy metals sector, I tend to stick to copper and nickel because they're kind of the pillars. A lot of these technologies are still in their infancy, and cobalts, vanadium, manganese, these things are, I don't want to say, well, their demand is variable. It is variable, right? We can engineer out certain minerals that are, if we're looking at new technologies like battery storage, whereas you can't engineer out nickel and copper. So, it's a good bet on the future of energy.
Okay. Yeah. So I hear it sounds like gold is your number one. You also like silver, copper, and nickel.
Yep, I do.
Okay.
Yeah.
And do you follow uranium?
I do. My bet in the uranium sector is very consolidated. I'm a very large shareholder of one incredibly early stage company, of which I'm a co-founder and a director. So, take that for what you will. But over the last 2 years, we've been acquiring property in the Athabasca Basin in Saskatchewan, and we're now the largest property owner in the Athabasca Basin. But it's a very early stage speculative play. And so, I've got all my eggs in that basket, very influential in the company. I like the direction. I like what we're doing. And so when it comes to uranium, I'm all in on that one company, and we'll see how that plays out.
What's the name of your company?
Stallion Discoveries.
Stanley Discoveries. Okay, cool.
Stallion, like the horse behind me, Stallion.
Nice. I like it.
Ticker is stud for anyone who wants to take a peek.
Okay. All right. Yeah. Okay. Moving on to interest rates. Okay. So about half the smart people that we talk to say that we're entering into this new economic cycle. And, the next, these cycles typically go in decades, and we're just beginning that now. They expect higher for longer, right? Then the other half say that the economy's stretched, the Fed's going to cut interest rates as soon as something breaks, the next black swan, because that's what they always do. And when faced with doing the right thing that's hard or kicking the can down the road for the next guy, they always kick the can down the road for the next guy instead of eating it themselves. So as far as we can see, we're doing no better than a coin flip here as far as like higher or cutting soon. What are your experts telling you, and what have you concluded from that?
Yeah, it's a great question. So probably I'm hearing the same thing you are, kind of a 50-50 split down the middle. But if I'm being honest with you, I guess you could say the higher for longer camp is where I land on this. And again, it's partially reflecting on history, Steve. You look at the last, I don't know, 80 years of interest rate policy, you'll see sort of 40-year trends occur, and there's lots of volatility and ups and downs along the way, but broad strokes, that's what we see. These are longer, almost generation long trends. I've been trying really hard, Steve, to see an avenue where we don't see massive price rising this winter. Like I can't see it though. I think we're going to see substantial inflation this winter. I think it's going to shock a lot of people. I think it's going to be higher than anyone expects. It's, there's some complex topics in macro, and there's some really simple ones. And a really simple one is that when the price of energy goes up, the price of everything goes up. And we're seeing oil run right now. This preempted the Saudis and the Russians extending their production cuts. That will amplify this pressure. As we mentioned earlier last week, Russia quietly put a temporary limit on exports of gas and diesel. The world's already short on the amount of diesel. We're struggling to produce the amount of diesel we need. This is the input. If you got to move it, you need diesel. Can't get around that. And so if you want to grow it, manufacture it, ship it, the price of energy matters. That's everything. Outside of OPEC, the only real growth in the oil sectors come from unconventional US shale, and that's now rolling over. Most American citizens and Canadian citizens might not read EIA inventory reports, but we're producing less oil from the Permian Basin, which kind of leads the pack there every month. October's projection is lower than September. The regular folks may not read those reports, but I guarantee you the Saudis and the Russians do, and they know what they're doing. They're weaponizing the energy in response. Diesel already at all-time highs in terms of this time of year, and it's up 60% since the summer in Europe. This is going to hurt, right? And this leads, right? So energy goes up. You may not feel it on the shelf right away, but you will. We've got to fuel the manufacturers, fuel the factories, fuel the tankers, get the products to the shelf. But, 6 months down the road, you'll feel it everywhere. And we can't keep draining the SPR and suppress the price. Like that's a limited game. We played that card already, anybody who saw this geopolitical conflict begin, last March should have known we're in for probably a 5-year conflict at best, and a long-term reshuffling of the board. And so to play a card like draining the SPR in the first 7 months, I didn't understand it. I was like, this is going to be a much longer game than anyone's thinking. Anyways, here we are, the second winter. We got blessed with mild weather last year in Europe. It's probably not going to happen again. But either way, the pressure's a lot stronger this year. The production's a lot lower. And the conflict hasn't gone anywhere. It's amplified. So, in response to that, long story short, I think inflation, there's only one way this can go in the short term. And how do you respond to that? By dropping rates? Like, I don't see it, So I'm prepared for more expensive capital for the foreseeable future.
Okay. So you see interest rates going higher for longer, which will prevent them. You see inflation going up because of increased energy costs. And in an environment like that, them cutting rates would only amplify the problem.
Yeah, they'd have to sort of go back on what they've promised and essentially restructure their entire thesis on raising rates in the first place. The public's got short memories, so maybe it'll work, but but I just don't see it. I don't see it. I see higher prices, much higher prices in the next 6 months. So, and
Okay.
and we're looking at already like record credit card delinquencies right now, auto loan delinquencies. We're seeing record rejections of new credit card applications. These are people who they're over their skis now. They can't afford their bills. They're looking for new credit and they can't get it anymore. Like, people are in trouble. And that's why I don't say this lightly. I'm very worried about massively increased prices that'll hit our shelves in the next 6 months. And I'm not talking about the frivolous expenditures. I mean, groceries and gas. Like, you know, and I can't say that loud enough because I'm very worried about it. Yeah.
Yeah, I look at it like I agree. I think that inflation is going to just slam into and grenade things that people need to survive, right? Energy, food, fuel, you need those to survive, right? Those are going to go up in price. Things that are going to go down in price and create opportunities is, man, if you've ever wanted a travel trailer, this is going to be the time to get it, right? If you ever wanted that car, this
Yeah.
will be the time to get it. You know, that dirt bike, that any of the extra stuff that people don't need to survive, there is going to be a landslide of deals coming. I already see it at my local Home Depot with barbecues. I mean, I got a awesome barbecue for 150 bucks and it was already put together for me. When have you ever gotten a barbecue that's assembled? You know what I mean? They always come in a box and they're like, there you go. Spend half your day putting this thing together. They had to be losing money on these things.
Right.
So I think it's already starting. Your grocery bill is going to get more. Your gas bill is going to get more. Your energy bill is going to get more. Things that you need to survive will get more expensive. Things that you don't will get cheap. Maybe I'm wrong. We'll see.
Yeah. 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 Yeah.
Okay. Questions from Jeffrey Spalding. Ask Jay if okay. Jay, do you think $80 to $90 a pound for uranium is time to start thinking about selling down uranium stocks? Or is there a time frame that you have in mind? What's the word on the street about this? Thank you.
Yeah. Okay. So first of all, any investment advice or any investment debate, Steve, is usually held between two people with different time horizons arguing about things that don't matter to the other person. So it really does depend on your situation, your available risk capital, you know, your time horizon. Long term, the price of uranium, I believe, if we want to keep our lights on, has to go up. I don't really see a way around that. And I see the infrastructure being built to support that thesis. We are moving towards more nuclear power. That is a fact. We don't have the uranium to power those plants. But there's going to be fluctuations along the way. And so, you know, can you take, you know, like any commodity, speculators enter the market, push prices up, prices get over their skis, and they correct a little bit. And so it all comes down to like, what's your time horizon? What kind of a pullback can you stomach? I mean, here's how I might phrase this. I'm buying gold producers right now. I'm down across the board on a lot of the positions that I have the most conviction in. In one case, about 20%. And you could say, oh, you know, like that's really scary. You know, it's the price going the wrong way. You might want to question your conviction, your decision making, all this stuff. And it's like, no, like I said, I'm here for a 3 to 5 year time period. And so what happens in the course of 3 months, it does not matter to me. It doesn't. You know, I'll continue maybe dollar cost averaging down, or I'll just sit in my position and know that if my time horizon is 5 years, then what happens inside 2 quarters is irrelevant because volatility is guaranteed. And so it really comes down to that with this investor here. I would say never be scared to take profits. I mean, you're never going to regret that. And if you're an investor in early stage companies, you know, when you get the opportunity to de-risk a position, you should do it. You should do it every time. Whatever de-risking looks like for you, if you're able to, you know, withdraw your principal, if you've received that much of gain and take the free ride, there's no downside. And don't sweat the upside you didn't receive if you took a bit of a gain, if that makes sense. In terms of uranium, my bet's super long. As I mentioned, Steve, I'm consolidated into one position. It's early stage. It's a 5-year bet for me, minimum. And, you know, we're going to develop that company and see what we find. And you know, the last 2 years, we've been in property acquisition, just kind of creating a bit of a block on what's available in the Athabasca. And next we'll get to work on what comes next. But it's a long period for me. So I'm not worried about uranium being too expensive today because I'm thinking multi-year. If you're trying to trade, I don't want to lean in on that because that's not what I do. Does that make sense?
It does. It does. Okay. From Murphy, he says, my question for Jay is, what is his opinion of the voluntary carbon market? Does he own any shares in any carbon credit companies? If so, which ones?
Yeah, that's an interesting sector, isn't it? So the carbon market, I think, has a place. I think that the world is moving in the direction of more respect for carbon emissions and solutions to excess carbon emissions. So if we're going to embrace that, and some will dispute that, but I'll say I believe that we're moving that direction, trying to clean up the planet. It's a good thing, right? On the back of that momentum, there's going to be all kinds of capitalists and speculators that are creating opportunities. I think one of those is probably the voluntary carbon market. Whether or not it has long-term credibility is to be determined. Right now, I see a lot of problems with how voluntary carbon credits are purchased and that cash is allocated. And whether or not it actually makes a difference in terms of cleaning up the planet is not proven. And I believe we're starting to see companies wake up to that. We have seen a decrease in activity in that market in response to the lack of clarity about how the cash invested in carbon credits is being distributed and whether or not it's actually making an impact. I am a shareholder of a company called VRIC Carbon. It's private. They will be going public at some point here, probably in the next 8 months, 12 months, we'll see. It's a very familiar business model, essentially what I just discussed, but I've got eyes on the ground in terms of how that cash is being reinvested in environmental projects. And I have a lot of confidence that they're doing everything they say they're going to do. And so if companies purchase carbon credits, their cash is getting put to work in a high utility manner. But it's a speculative voluntary market. And so I want a horse in the race. I want some exposure there. I'm with a team that I believe in and have a lot of faith and trust in. But it's a high risk market because it's absolutely unproven. And whether or not it'll even exist in 5 years, I wouldn't give you a high conviction yes. So I've put some cash that direction. I've got a horse in the race. Like I said, I'm people driven. I like the team. I like the project. But it's an early stage bet. So worth a look, but look at it speculatively.
Okay. All right. I haven't played around with that one yet. I don't have enough space up in my head to do it. Awesome. Well, thank you, Jay. What you have a signature course coming up. What can you tell us about that? What can we get from it when we sign up?
Yeah, it's called the Commodity University. This is a 10 chapter video course that walks investors who want to begin building a portfolio in the commodity business through like a 101. And it starts super beginner. I mean, essentially the first chapter, Steve, is what is a commodity? And, at the end here, we're talking about risk management and portfolio construction. We do deep dives into supply and demand dynamics. I just got someone in the window here. Deep dive into supply and demand dynamics. We go deep into gold, silver, copper, energy metals, and uranium. And so this course was built in response to the overwhelming questions I've had from newsletter subscribers, YouTube subscribers, conference attendees that have asked me, how do I get started building a commodity portfolio? And so we built this course in response to that. Anybody who wants to check it out, it's at thecommodityuniversity.com. Hope I can promote that here. But it's,
yes.
I love content, man. And I think it's a really smart time to begin building a commodity portfolio. So I feel really good about pushing people this direction. And, if people go in that direction, this is a great resource to make sure you're armed with the basics, right? The fundamentals. Yeah.
Awesome. How much is it?
$149.
Okay, cool. And
I want, it's a 101, right? I want people that are new to the sector to be able to bite off a lot.
Good. Okay. And you're doing the VRIC again this year. Last year was a blast. It was my first time going there. Did a bunch of interviews and it was a lot of fun. Can't wait for the next one. I remember asking my the missus afterwards, I'm like, what's the number one thing you learned from this? And she turned to me and she's all, honey, I need to buy more gold. I'm like, yes. It was great. So what can we expect at the next one?
Yeah, you can expect about 350 junior mining companies on the trade show floor, about 120 keynote speakers. And the speakers that we invite are money managers, serially successful entrepreneurs. We typically have some political exposure. In the past, we've had former Prime Minister Stephen Harper and former President of Mexico, Felipe Calderon, and a few others. We've got some cool things in the pipeline that I can't announce just yet, but we're gonna swing to impress again this year. And the purpose here is very much like my podcast, to be honest, Steve. It's like I want to hear from individuals who have allocated capital very intelligently over the last couple of decades, have great track records, And I want to hear where they're putting cash right now. I want to hear how they're thinking about the world, how they're processing the events that I'm watching, and where they're investing as a consequence. And so investors show up to hear those perspectives from folks that, you know, like Rick Rule and Warren Irwin, who you have on your program, and many, many more. And then they can walk the show floor and get to know the companies that are exploring, developing, and producing for the commodities that are powering the world. So we'll probably have about 5,000 investors this year. And the focus is all on commodity investment. So if you're curious where the stuff that we need in the future is going to come from, this is a great place to be.
Nice. I look forward to it. I placed 2 bets after your last conference. One was on Uranium Royalty Corporation, and the other one was on Uranium Energy Corporation. And the profits from those 2 bets alone have paid for that conference many times over. It was awesome.
Love hearing that.
Thank you very much, Jay. There'll be links to everything down in the show notes if you guys want to check out his show, the VRIC, or his upcoming signature course. Thank you again, sir. You have a great rest of the day.
Yeah, you too, Steve. Thanks for having me, man. Great catching up.